at marketgauge.com. Michelle, thanks so much for joining us. I mean, it's so hard, right? Because I think we're putting in the best year-to-date gains for the S&P 500 in the 21st century. So you'd forgive us if we're not a little bit excited to get to year end.
Yes, and hi, Amber. Well, it's so interesting, right? Exactly that, because it seems like all the headwinds that the market should have had has really basically been ignored. And I think the big patience that we're talking about right now is to see how the market digests these yields that actually rose a little bit after the Fed cut. And now I see her coming down a little bit today. And even if there's a hint of more rate cuts, or we're in a trajectory now, of course, with the end of the higher for longer, whether it takes a month or 6 months, what happens now in some of these inside sectors of the U.S. economy is what we're waiting for. So the small and the mid-cap stocks, which have been range-bound, the whole consumer sector is measured by an ETF XRT, which is staples and discretionary, and of course transportation, which now with the port strike will be very interesting. And I think once we see some kind of reconcile of the recent range that we've had over the last 3 months and we break out, that would be worthwhile following. And so at this point we haven't, so we feel it's probably a good time to sit back and kind of see what happens.
Where is the port strike on your list of worries, and what would be your threshold in moving it to the top of the list?
At this point, I looked at a list of the stores that do the most importing through these ports. Walmart was one, the top one actually, and then it was IKEA and then Samsung. And I looked at the list, and so yeah, stockpiling should be an interesting thing. Obviously, we'll see what happens with the wages increase. I mean, these could be inflationary. We're going into a buying season, obviously, with holidays upon us. So we don't really know how long it will last or what the impact will be, but it's just another one of those areas that are circling around us that are looking somewhat inflationary with all the talk of no inflation. And I think it's interesting that this was 1977, the last time we had this level of strike. And that was really where inflation started to pick up again, when people thought it was over, coming out of sort of a quasi-recession, similar to what we have now. And that's why gold is so interesting, because gold has been the mirror, the cracks, if you will, of what we're not necessarily looking at when we look at the indices.
I think that's great perspective, and maybe we can elaborate on that in the context of Jerome Powell's speech yesterday, where, you know, counter to some of the Fed speak that we've been getting recently, where, you know, some members were open to another 50 basis point cut, Jerome Powell was really kind of pumping the brakes on that chatter.
Well, he's been actually quite impressive as the statesman, if you will, for the Fed. I mean, he's done a great job. People had a lot of doubt about what he was doing when he kept the rates higher for longer for so long, because people saw contraction in the labor market and in some of the manufacturing numbers. So right now, what he's basically doing is doing what he's been doing all along, which is saying, I'm data dependent. I'm not going to get hysterical one way or another. Obviously, we've turned the corner now with the first cut, and that's going to continue. And we're not going to commit to a schedule, which is smart, because he has to be seeing the fact that there are potential inflationary factors around, number one. But at the same token, he has to be seeing that even though he thinks the labor market doesn't need to shrink more, that at this point it could. So I think what he's doing is suggesting soft landing could be on the table, but yet let's not get too celebratory about that yet. And so, you know, he's smarter than what people really anticipated he would be, I think. And when I say people, I mean investors.
Yeah, and I feel like he has lingered with the shadow of a doubt for a lot of his tenure. But, you know, to his credit, there's been no recession. There's been no major accident in the financial markets. That's one thing to consider for investors. Can't ignore the lagging signal or the signal that oil is giving us, and the fact that even with geopolitical tensions, it's not budging, still sub 70. You know, is that demand concerns? Is that positioning? What's the signal from oil? Are you ready to view it as an opportunity yet?
Well, I definitely like the fact that it's holding around $65. I know yesterday it looked like it was maybe going to rally, and right, this morning's dip is a bit of a surprise. But it's really, again, kind of like what we just said about those sectors, range bound. And so we're watching very carefully. A lot of the reason why it is down is because OPEC Plus and a lot of the Middle Eastern producing countries are saying that they're not going to cut production. In fact, if anything, they're going to raise production. And so there's a lot of oil around. And the United States, by the way, bought 6 million barrels yesterday at these levels. So even they're anticipating that it may not go much lower is how I'm looking at it. So again, if people can be patient, if we break down under 65, then I think that would definitely give Powell more incentive to actually continue to cut, maybe even more aggressively, which of course will be great for a lot of areas of the market that have suffered, particularly like those small and mid caps and the consumers we were talking about. If it breaks over $70 a barrel, I would start to think that all of this complacency in oil is misplaced, and we probably need to be a little bit more alert, a la the late 70s when oil looked like it was going to crash and then it came roaring back, which of course sent inflation into craziness as we got into the end of the 70s. So again, patience. We don't know yet, Amber, exactly. And I think it behooves people to just step back a little bit. We're near all-time highs. This consolidation is healthy, and it means you won't miss out if we break out in terms of the, like I said, some of those other areas that have been relatively sideline.
Well, I love how you were talking about thresholds. If oil is this, then that. Can you do that with the U.S. jobs number that we're going to get on Friday? Because in some ways we have to be patient with that too. And I imagine there's a threshold where things, it's a scary number. Maybe it confirms a 50 basis point cut, or one that signals, okay, it's a green light, you can buy stocks.
I don't know if I necessarily think the jobs market's going to be the end-all be-all for what happens with the Fed, unless we have some major surprise, of course. But short of that, the anticipation will probably be that it'll be somewhere within the range of where it was over the last couple of months, in that we may see a little bit. Well, the jobless claims will be a big key, right? And the jobless claims have been, talk about a range bound. Essentially, we've been between 200,000 and 250,000 jobless claims numbers that come out every week. So that tells you that we're not seeing a tremendous amount of movement in terms of more people not working. Now, you do hear a lot of these jobs are part-time jobs. People don't have full-time jobs. The JOLTS report was a surprise last month when that came out. I think that comes out again this week. So we'll see. But you know what, Amber, if I had to give one tip, here's what I would watch. I would watch the long bonds. The TLTs is the ETF to watch that, because I think that's going to signal a lot. If it starts rallying or yields start dropping, then I think what that does is suggest that there is a little bit more nervousness about the future of the economy than what the indices are reflecting. If they don't move very much, I think that's a healthy sign. If the long bonds start outperforming the SPY, the S&P 500, then I think the conversation could change a little bit. More fear of recession, maybe even more fear of inflation. And then, of course, that would be coupled with what we see with oil. So I wouldn't worry too much about jobs. I think the TLTs will tell you exactly